Cracker Barrel Old Country Store has long occupied a distinctive place in the American commercial landscape. Located primarily along highways and interstates, its restaurants and retail stores became familiar landmarks for travelers across much of the United States. The brand was built around an image of continuity, an intentionally preserved version of rural Americana designed to feel unchanged by time. History shows, however, that even businesses grounded in tradition remain subject to shifting economic conditions. The story of Cracker Barrel is not one of sudden collapse, but of a company confronting sustained structural pressures as consumer behavior, travel patterns, and cost dynamics evolve. Photographs from the late 20th century show crowded dining rooms, rocking chairs lining wooden porches, and families pausing from long drives. During that period, the company's business model aligned closely with the rhythms of American travel. Understanding how that alignment formed and how it has weakened requires returning to its origins. Cracker Barrel was founded in 1969 in Lebanon, Tennessee, by Dan Evans, a former executive with Shell Oil. Evans conceived the restaurant after observing that the expansion of the interstate highway system had transformed travel while leaving roadside dining inconsistent in quality. His goal was to create a standardized restaurant that offered predictability, comfort, and familiarity to travelers. From its earliest locations, Cracker Barrel combined a full-service restaurant with a retail store modeled after a traditional general store. The decor emphasized antiques and reproductions meant to evoke rural Southern life. This aesthetic aligned with broader cultural trends of the late 20th century, as increased mobility and suburbanization heightened demand for experiences that felt rooted and familiar. The company expanded steadily through the 1970s and became publicly traded in 1981, providing capital to accelerate growth. Its locations were typically placed near highway exits, serving both travelers and local communities. This strategy reflected the transportation patterns and consumer expectations of the era. Cracker Barrel's most sustained period of growth occurred during the 1980s and 1990s. Interstate travel increased, and families relied heavily on chain restaurants that offered consistency across regions. The company's emphasis on value-oriented meals, large portions, and standardized service supported customer loyalty. Industry reporting during this period frequently highlighted Cracker Barrel's hybrid restaurant and retail model as a distinguishing feature. By the early 2000s, the company operated several hundred locations nationwide, particularly in suburban and highway-adjacent markets. The brand became closely associated with family travel and routine long-distance driving. At the same time, broader shifts in the restaurant industry began to emerge. Consumer preferences gradually moved toward faster service formats, a wider variety of cuisines, and increasing convenience. While these changes did not immediately undermine Cracker Barrel's performance, they altered the competitive environment in which it operated. By the 2000s, Cracker Barrel faced mounting challenges common to the casual dining sector. Traffic growth slowed, operating costs rose, and competition intensified from fast casual chains, grocery-prepared foods, and delivery-focused models. Demographic changes also became more pronounced, as younger consumers displayed weaker attachment to traditional roadside dining experiences. The COVID-19 pandemic in 2020 intensified these pressures. Travel declined sharply, dining rooms closed temporarily, and revenue fell. Although the company adapted through expanded takeout and operational adjustments, the disruption exposed vulnerabilities in a model heavily reliant on in-person dining and travel-related traffic. Recent financial results illustrate the persistence of these challenges. In the first quarter of fiscal 2026, Cracker Barrel reported total revenue of approximately $797 million, representing a 5.7% decline compared to the same quarter in the prior year. Comparable restaurant sales declined 4.7%, while comparable retail sales declined 8.5%. The company reported a GAAP net loss of approximately $24.6 million for the quarter, compared with a net loss of $4.8 million in the prior year period. Adjusted EBITDA declined to $37.7 million, down from $45.8 million a year earlier. Management cited lower traffic, cost pressures, and ongoing restructuring efforts as contributing factors. In response, the company revised its fiscal 2026 outlook, lowering projected revenue and adjusted EBITDA expectations. Leadership emphasized cost control initiatives, menu pricing actions, and operational changes intended to stabilize performance, while acknowledging continued pressure from inflation and consumer demand trends. Today, Cracker Barrel remains an operating national chain, but its position within American dining culture is more constrained than during its peak decades. Growth has slowed, profitability has come under pressure, and the company faces ongoing efforts to balance adaptation with the preservation of its long-standing identity. The legacy of Cracker Barrel lies not in disappearance, but in endurance under strain. The rocking chairs remain on the porch, and the brand continues to serve millions of customers. Yet the highways it once depended upon now carry a different America, one shaped by new habits, new economics, and a changing relationship between memory and commerce.